Welcome to Breaking News to Trading Moves. Today we're focused on a really key piece of market news, and we're going to try to clarify what it tells us about AI infrastructure spending, where it's going, and just how fast.
And that news, of course, is all about Nvidia's latest earnings report and their forward guidance. The results weren't just good. They were far beyond what most analysts had modeled. It's really kicked off a major conversation about the durability of this whole AI investment cycle.
Right. And that's the core question for us today, the one that really drives how capital gets allocated across the entire tech sector. Are we looking at the early days of a long, maybe multi-year investment cycle into this new kind of computing? Or are these signals maybe the start of a bubble, where valuations get a little disconnected from what can be monetized in the near term?
To frame that debate for you, we really need to follow the money. First, we'll establish what the core demand signal is, why these numbers were so strong in the first place. Then we'll go through and identify the specific market categories, the companies that are set to benefit from this, the winners.
And just as important, we have to look at the other side. The sectors facing pressure, maybe some budget constraints, and a potential rotation of capital away from them. The losers. Because when this much money floods into one part of the market, it often has to come from somewhere else.
Exactly.
Okay, so let's start with a core signal, the demand for these AI accelerators. The first thing to say is just. Nvidia's quarter was a massive outperformance. It put to bed any of those short-term worries that the demand curve for AI compute was maybe starting to flatten out.
Yeah, the term blowout really fits here. And not just for the earnings they already booked, but for the forward guidance. That guidance is the real story. It confirms this idea that the infrastructure build-out is actually picking up speed, driven by some pretty structural market dynamics, not just hype.
So what's the structural element here? We've had large language models in the headlines for a couple of years now. Why is demand still running so hot? And why are customers paying what are clearly very high prices for the hardware?
It really boils down to two things: strategic necessity and supply constraints. The main message here is that the demand for these top-of-the-line AI accelerators, the GPUs you need for this stuff, it's just not slowing down.
Even after all the capital the big hyperscalers have already spent.
Right. And the second part, which really speaks to the guidance, is procurement lead times.
Explain that. How do current orders validate a multi-year idea?
Well, when a hyperscaler, say an Amazon or a Microsoft, places an order for the newest NVIDIA GPUs, they're not getting them next week. The complexity of making these chips, mostly through TSMC, means an order placed today might not be fulfilled for 12, maybe even 18 months.
Ah, okay.
So when you see strong forward guidance, it means their order books are already full deep into the future. It confirms these are long-term commitments from the biggest spenders. It validates their multi-year capex plans.
So it's not just a snapshot of last quarter. It's really a window into the next, year or two of planned spending from the world's biggest companies.
Precisely. And this validates the idea that data center capex is going to stay elevated for longer than people thought. And this is important, this spending is very focused. It's not just general spending on standard servers. It's specifically directed at getting and deploying these leading GPU platforms that can handle the intense AI workloads. The kind of thing a normal CPU-only server just can't do efficiently.
And this evidence is what's really fueling that long investment cycle argument. If the company at the absolute center of this whole ecosystem gives such confident long-range guidance, it suggests the build-out phase is still in its expansionary period, potentially for years to come.
And on top of that, we're starting to see a new demand driver emerge, something called sovereign AI.
Sovereign AI.
Yeah. Before, the race was mostly between 4 or 5 big U.S. tech giants. Now you have governments and state-backed groups across Europe, the Middle East, Asia. They're all realizing that having access to AI compute power is a matter of national security.
So they're competing with the hyperscalers for the same limited supply of chips.
Exactly. It adds a whole new layer of structural demand. And if you have sovereign nations competing with tech giants for supply, it suggests capacity is going to stay tight, which gives NVIDIA continued pricing power.
Right. If we were near a peak, you'd expect to see customers maybe delaying orders or more cautious language about inventory.
But instead, you see strong pricing, huge backlogs, and a whole new class of very well-funded buyers jumping in. It suggests this build-out isn't just robust, but it could go on for a while as this global competition heats up.
And the continued profitability of Nvidia, that's ticker NVDA, is also key here. They aren't just selling a commodity part.
No, and that brings us to their competitive advantage. The CUDA software platform. It's been built up over decades. It's the industry standard for AI because almost all the AI models and the developer tools are optimized for, or frankly, locked into, the CUDA ecosystem. Switching to a competitor's chip is incredibly hard and expensive for customers.
So that platform advantage is what justifies their pricing and ensures that even when competitors show up, NVIDIA stays in that central gatekeeping role.
Yeah, that's it. So when NVDA reports, the market listens because their numbers either confirm or deny this whole spending story for the entire tech transformation. The strength we just saw takes a lot of uncertainty off the table about short-term cloud spending.
It's an affirmation that the race for AI dominance is still in its earliest phase, the one that requires the most infrastructure. The focus is just on getting access to compute, almost no matter the cost.
And that forces a reallocation of focus for investors. The question is no longer, is AI a real technology? The question now is, how long does this construction phase last, and who else benefits from all this capital flowing into the hardware?
Let me just play devil's advocate for a second, though. If the guidance is based on lead times of, say, 18 months, and their gross margins are astronomical, approaching 75%, doesn't that feel a little like a bubble? I mean, does any tech company maintain that kind of dominance and pricing power forever?
And that is the core tension in the market right now. You're right. While the current dynamics absolutely validate the long cycle argument, the demand is real, it's structural, the valuation on NVDA reflects a belief that those incredibly high margins can be sustained. Whether they can or not depends entirely on if competitors can really crack that CUDA moat. For now, the structural demand we've talked about provides cover for those valuations, but you're right to point out that competition and gravity will eventually put pressure on those margins. But based on these results, that pressure is not coming anytime soon.
Okay, so that structural strength leads us right to the winners. The clarity from this NVIDIA signal is directing capital towards specific, connected parts of the market. Let's start with the most obvious group, the companies actually building the specialized hardware.
Right. If you accept that we're in the expansion phase of a long AI cycle, then the companies making the hardware are the most direct beneficiaries. And this isn't just about NVDA, even though they are the center of it all.
Right, NVIDIA, ticker NVDA, is the anchor here. They're the gold standard for GPU platforms. Their results validate their pricing power and also their ability to scale up production to meet this just unprecedented demand. They're capturing almost all of the profit in the market right now.
And their market position is reinforced by that ecosystem, as we said, but also by how fast they innovate. They're not standing still. They keep pushing what's possible with density and connectivity, forcing any competitor to constantly play catch-up.
But as you said, they can't possibly satisfy all of the global demand, which brings us to advanced micro devices. Ticker AMD. AMD is positioned to benefit just by being a credible alternative in this environment.
Absolutely. AMD is competing directly in the AI accelerator space with their MI series chips. And the fact that the overall market demand is just so strong means there is plenty of room for a number two player. I mean, big cloud providers and corporate buyers, they are naturally worried about relying on a single supplier for something as strategic as AI compute. That's where AMD becomes so important.
So AMD isn't just riding the wave, they're benefiting from a very specific desire among big customers for vendor diversification.
Exactly. The hyperscalers will approach AMD strategically. They might want custom silicon to optimize their own systems, or they'll use AMD's offerings to get some negotiating leverage against Nvidia. AMD's success is tied to this idea that the total market for AI accelerators is just growing so big that it's beyond what any single company can supply.
So when the whole market is scrambling for compute, alternative providers who can deliver at scale, like AMD, they become really valuable.
It creates a strong tailwind for them. For investors, putting money into AMD is a bet on the long-term cycle and the fact that customers will inevitably need more than one vendor to secure their compute needs for the future.
Okay, so moving past the chip makers themselves, the next big winners have to be the hyperscale cloud providers. NVIDIA's strong numbers are basically the clearest proof you can get that giants like Amazon and Microsoft are pouring billions of dollars into building out the data centers that use all these products.
Yes, and they play a really complex role here. They're the biggest customers for the GPUs. They're the ones spending the capital. But they are also the main providers of AI access for everyone else. Think about Microsoft, ticker MSFT, and Amazon, ticker AMZN, with Azure and AWS. Their advantage comes from something you could call margin stacking.
Margin stacking, okay, that sounds important. Yeah. How do they leverage that massive capital spend to do more than just rent out hardware?
It works in layers. So layer 1, they buy the chips from Nvidia. Layer 2, they rent out the raw compute the GPU hours to customers. That's the first stream of revenue. But the real stacking happens on layers 3 and 4. Layer 3. They charge extra for all the platform services, the networking, the storage, the tools you need to actually run those workloads.
Okay.
And then layer 4, they charge you again for access to their own large language models, like OpenAI's models through Azure and their software development kits.
So they're monetizing the same piece of hardware, that NVDA chip, 4 or 5 different times. They turn a huge upfront cost into a recurring revenue engine with higher and higher margins as you move up the software stack.
Exactly. And that's why they are such key beneficiaries. They acquire the infrastructure at a massive scale, which lowers their own internal costs. And then they sell these bundled higher value services that run on top of it all. It's a powerful economic advantage.
So that positions MSFT and AMZN as maybe a safer, more diversified way to play this AI infrastructure trend compared to just owning the chip maker?
That's the critical difference. If you invest in MSFT or AMZN, you get exposure to their whole business: cloud, software, e-commerce, advertising, plus this massive AI build-out and the monetization that comes after. They're like a diversified hedge against a single chip generation becoming obsolete, because their revenue is tied to the utility of AI itself, not just selling one component.
It sounds like the market is rewarding them for not just building the road, but for owning all the toll booths and all the services that run on it.
That's a great analogy. Their position in the cloud lets them absorb that massive initial cost and then generate this sticky recurring revenue from businesses who want to use these resources without building it all themselves.
Right. So now we have to trace the money from those cloud servers down to the actual physical ground they sit on. This kind of growth in AI infrastructure means a multi-year compounding need for very specialized physical space, something beyond what a traditional data center can offer.
This is where the physical landlords and the infrastructure specialists come in. I mean, the requirements for AI compute are pushing the limits of physical engineering. A standard data center rack might draw, 8 to 10 kilowatts of power. A rack full of the latest Nvidia accelerator can easily draw 50, 60, even over 80 kilowatts.
Wow, that's an order of magnitude difference in power density. What does that mean physically?
It means you have to completely rethink the building. AI infrastructure demands specialized capabilities, heavier racks, way more power capacity per square foot, and this is the big one, specialized high-density cooling. Standard air conditioning just can't get rid of the heat from an 80-kilowatt rack, so you're seeing a rapid move to liquid cooling solutions, often direct-to-chip or even immersion cooling.
So the demand for chips directly translates into premium contracts for data center specialists who can handle this extreme infrastructure. Companies like Equity Commonwealth, ticker EQIX, and Digital Realty Trust, DLR.
Precisely. These are colocation and data center specialists. They're often structured as real estate investment trusts, or REITs. They benefit directly because their customers, the hyperscalers and increasingly large enterprises, need this AI-ready capacity that can handle the power and thermal requirements. EQIX and DLR are perfectly positioned for that.
And are they just building more of the same, or is the specialization itself justifying higher lease rates?
It's absolutely the specialization. Building an AI-ready facility is more complex, it's more expensive, but once it's built, that capacity is scarce, and it's mission critical for the customer. And the signal from Nvidia that AI is spreading across all industries, finance, pharma, you name it, that reinforces the long-term demand story for this kind of physical infrastructure.
Which confirms this isn't just a temporary spike from a few cloud providers, it's a broader transformation.
Absolutely. As AI gets deeper into every sector, the need for this kind of robust, high-density computing space just grows and grows. It gives a multi-year runway for these data center landlords.
Okay, so while the winners are riding this infrastructure boom, we have to look at the other side of the equation. There's a finite amount of capital in the market, and when you see this kind of verifiable profitability, it can trigger a pretty quick rotation of funds out of slower or more speculative areas.
Yeah, this rotation is very tactical. When the core parts of the supply chain confirm multi-year profit visibility, investors tend to stop betting on future promises, and they put their capital where the proven earnings are. And that pressure shows up in about 3 distinct groups.
Let's start with the first, the smaller, pure-play AI software companies. What we've discussed shows that most of the profit right now is concentrated in the chips and the hyperscale platforms. It's not really flowing down to these smaller application companies yet.
And that creates a fundamental economic problem. A lot of these smaller companies, like, say, C3.ai, ticker AI, or SoundHound AI, which is SOUN, they trade on these massive expectations of future dominance, not on proven positive cash flow right now. They're the potential trade.
And when Nvidia comes out and confirms where the actual capital is being spent on infrastructure that costs billions, that gap becomes a glaring risk.
It's all about inference cost and compute burn rate. These smaller AI companies, they aren't building their own billion-dollar data centers. They have to rent compute from the hyperscalers, from Azure or AWS. So that means every single transaction, every query their software runs, incurs a high variable cost.
So they're selling software that relies on the very expensive infrastructure built by their cloud partners, which just crushes their gross margins.
Exactly. Even if they get great customer adoption, the underlying economics of renting expensive cloud compute makes it really hard to get to scale profitably. They're paying a premium toll to the same hyperscalers who are also, by the way, competing with them in the software space.
So when investors refocus on where the verifiable earnings are, capital can rotate out of these speculative stories pretty fast.
The market is basically doing an arbitrage of profitability. When the companies making the picks and shovels, the NVDA and MSFTs of the world, are earning massive returns, the risk tolerance for waiting on software companies to maybe find digital gold goes down dramatically. The rotation is a move away from hope and toward proven financial results.
Okay, so next up, let's look at the providers of traditional enterprise hardware. This sector is facing a pretty severe budget squeeze because of this focus on AI capex. Every dollar in a company's tech budget is now competing with these high-priority AI projects.
This is a classic displacement effect. Your traditional server and storage refreshes, the ones that rely on conventional architectures, they're at a serious risk of being delayed or downsized. If a CIO has a limited budget and has to choose between a routine refresh of database servers and funding a new specialized AI cluster, the AI project is going to win almost every time.
Right. And companies like Hewlett-Packard Enterprise, ticker HPE, and Dell Technologies, ticker DELL, they rely heavily on that conventional, high-volume hardware business. They seem to be stuck fighting a war on two fronts.
That two-front war is their core problem. On one side, they have the ongoing, decades-long pressure of workloads moving to the cloud, so customers are already buying fewer traditional servers. And on the other side, they're seeing demand move toward these hyper-specialized AI systems. Right at the moment, NVIDIA confirms that's where all the big spending is going.
So if the big money is going into specialized GPU clusters, often managed by the hyperscalers themselves, where does that leave the traditional volume business for HPE and DEL?
It puts immense pressure on their margins. They're kind of squeezed out of the high-margin custom AI infrastructure sales, which are dominated by the chip vendors and cloud giants. So they're left fighting over a shrinking pool of traditional server refresh dollars, which is a lower margin business and subject to delays.
So their challenge isn't just adapting their products, it's changing the core economics of their business model away from general volume, which is a very difficult thing to do.
Exactly. Unless they can quickly become essential to the AI build-out, they risk becoming secondary players, suffering as traditional budgets get redirected to the cloud and to specialized AI infrastructure.
Okay, and for our final group of losers, we turn to companies that are more rooted in legacy chip segments and the traditional PC market. Nvidia's strengths really highlights this widening growth gap between the AI leaders and more traditional tech sectors.
Yeah, the recent results just show how dramatically the AI leaders have pulled ahead, both in growth and profitability, compared to businesses that are centered on, the PC cycle or more traditional chips. And this creates a market psychology problem for companies that don't have enough exposure to the hot area.
Meaning, if the market decides AI infrastructure is the main engine for all future tech returns, then the names in this legacy category risk becoming, well, a source of cash for trades into Nvidia and the hyperscalers.
This rotation of capital seeking better returns is particularly relevant for companies like Intel, ticker INTC, and HP Inc., ticker HPQ. An investor looks at NVDA's growth, then looks at a company that's lagging, and decides to sell the lagger to free up cash to buy more of the proven winner.
Let's focus on Intel INTC for a second. They are investing heavily, they're trying to compete in AI, but the market's reaction suggests it's a real struggle.
Intel's core issue is twofold. It's technology and exposure. Technologically, they are playing catch-up in the high-end accelerator space where NVIDIA has that huge head start and the CUDA moat. And on top of that, their foundry model, which is key to their long-term turnaround, is under a lot of scrutiny compared to the dominance of TSMC, which of course makes NVIDIA's best chips.
And the exposure problem for both INTC and HPQ is that they just don't have enough of their revenue tied to the core AI data center build-out.
That's the key. They might sell some components or systems to data centers, But they aren't at the very center of the current capex boom, which is all about high-end GPUs. For HPQ, the focus is still mostly on the cyclical, lower growth PC market. They're not fully participating in the AI boom.
And the risk profile here is compounded, right? If general tech spending slows down later because of the economy, these companies would still feel the full impact of that, but without the offset from booming AI revenue.
They're caught in a difficult spot where investors are rewarding highly specialized growth. The market wants a piece of high-end AI compute, making these more generalized or legacy-focused companies less attractive for capital right now.
This really highlights the incredible differentiation that's happening in tech. It's not a rising tide lifting all boats. It's more like a rapid construction project, creating a few very wealthy landowners while making life harder for a lot of the existing businesses.
That's a very accurate way to put it. The capital is not being spread evenly. It's concentrated, it's focused, and it's starving capital from traditional hardware and more speculative software.
So let's just synthesize the landscape that NVIDIA's results have created. The market has gotten confirmation that the AI infrastructure build-out is not just not slowing down, it's actually accelerating. It's driven by structural lead times, sovereign demand, and that immense CUDA ecosystem.
And this confidence is channeling a massive amount of capital into the underlying physical and cloud infrastructure. It's creating very clear winners in chips, cloud platforms, and specialized data center real estate. At the same time, this concentration is causing pressure on older tech sectors and on those pre-revenue software companies that trade more on potential than on actual profit.
The rotation of capital is tactical. It's rooted in the confirmation that this build-out is real, it's massive, and it's incredibly expensive, a cost that only a handful of players can really afford.
Which brings us back to that overarching question for you, the listener, to think about. Does this powerful, concentrated flow of investment into the core foundation of this technology signal the early stages of a sustainable, multi-year transformation? One that will generate returns for decades as AI works its way into every industry.
Or is the intense speed of this capital flow and the extreme valuations that come with it? Is it just building towards an eventual bubble? One defined by rapidly inflating asset prices, centered on a technology that has yet to fully prove out its mass market monetization beyond this infrastructure layer.
That tension between the undeniable structural demand on one side and the unprecedented cost and valuation on the other, that is the debate that is going to define this market for the next several quarters.
This is not financial advice or buy or sell recommendations. This is pure the opinion of the author.